Hello, I'm Devashish Chakravarty. Today let us look at marginal costing as a management tool. What is marginal costing? It's a part of cost accounting. In cost accounting, we look at fixed costs and variable costs of the process or production. All costs can be divided into two components. One is that is dependent on the volume of business. That would be known as the variable cost. So if the business is of producing a certain quantity of products, then for each increase in quantity, there would be a corresponding increase in cost. If you are able to identify that cost, that would be a variable cost. Let us take an example. If one is producing chairs made of wood, then the input material into the chair would be, let's say, some quantity of wood. The cost of that particular quantity of wood would come out as a variable cost. Why so? Because if you needed to make double the number of chairs, you would need exactly double the amount of wood. Similarly, if we consider carpenters who are making the chairs, if one carpenter makes 3 chairs a day, and if you require 2 carpenters, that would require double the number of human resources. That would also turn out to be a variable cost. On the other hand, imagine that we have a room in which the carpenters are working. You can put up to 5 carpenters in that room. Presently, you have 1 carpenter in that room producing 3 chairs. If you require 6 chairs a day, you will put a second carpenter in the same room and get 6 chairs output. The additional increase in output does not impact the cost or the rent of that room. That would turn out to be a fixed cost. Traditionally in accounting, revenue minus variable cost is known as the contribution. That is, the total revenue earned from sales minus the variable cost would come out as contribution. Contribution minus the total fixed cost would be the profit. So marginal costing talks about the increase in cost or the increase in variable cost for every additional unit of production. Thus, it ignores fixed costs. How does marginal cost help us as a method of accounts? It helps us take short-term decisions effectively. If the marginal cost of production is known and the marginal revenue from that sale is also known, it helps us taking a decision of whether to produce or not to produce. A second method of where marginal costing helps us is, most of the time, the resources needed for production are limited. Generally, the constraint towards higher level of production comes down to 1 or 2 critical resources. Once we are aware of what is the critical resource, then marginal cost helps us determine how to maximize that particular resource. Once the critical resource is known, then the goal of management is to maximize the revenue per unit of that resource. Let us assume that we have 2 carpenters and they are the critical resource, given that we have unlimited supply of wood. Then the idea would be to maximize the revenue per carpenter. Marginal costing on a resource basis helps us do that, and hence it is a very effective management tool for short-term decision making. And